Let me now bring on board Kenneth Andrade, Chief Investment Officer with IDFC Mutual Fund, to talk about the new NFO, which is IDFC Equity Opportunity Fund. Kenneth, good morning. Thank you for joining us. Let's first talk about the new NFO. You're launching a new NFO at a time when market conditions are not strong and supportive, and there is very little preference towards small and mid-cap stocks.
I agree. Market's not been at its best for the last couple of months or couple of quarters. We've also got a lot of concerns as far as the macroeconomic environment is concerned, heading into elections. So a fair amount of headwinds out there, not really conducive for putting new products into the market. But I think that's where the opportunity effectively lies. We're trying to build a portfolio in these at this particular point in time, and look outside the mainstream top 200, top 300 companies that is normally on the radar of most analysts and portfolio managers. So the Equity Opportunities Fund, this will be the first series, effectively will focus on trying to have a reasonably strong bottoms-up approach, find those level of entrepreneurs, those balance sheets that exist, fairly well capitalized, low leverage, with the ability to grow their business in an environment like this. Surprisingly, we find a lot of them out there, and this portfolio will just be the building blocks to what our business, the mature part of our entire portfolios will hold eventually. So this is where we start building the ideas in, and our existing mature portfolios from IDFC Classic, Sterling Premier, Infrastructure, and a couple of our products will actually build on to these ideas that are there.
So Kenneth, give us some color of what is it that you like from the beaten down space that constitutes this particular fund? What sectors, find favor with you?
Look, what we try to address out here is the very large ancillary part of corporate India. So these are, to put it up front, this is not small companies becoming large companies. These are small companies who are put in capacity for various reasons, more macroeconomic than anything else. Their capacity utilizations are not been optimal. Second, you've also got return on equity in the entire subset of companies out there under 10%. So like in the previous cycle, you've got companies which will accumulate a lot of cash on book. They will be debt free, and should you have a slight pickup in the business volumes, whether it's driven from the international business, new customers, or the domestic business, I think the leverage on profitability will be huge. So our sense is that it's a waiting period of probably 12 to 18 months. The only industry, is to get back to the question that you asked me, just the only industry that we won't be holding out here is the financial services industry, because it's a scale business, and it's a large business. So that's probably the only space that we will not have in this product.
Kenneth, what about the overall market? Do you worry about market internals? When we started the year, there were bulls everywhere. Suddenly there are bears everywhere.
Well, we've been having this switch on, switch off relationship with the market for the last 5, 6 years. So it's really not very, while the market internals or the market technicals might change periodically over a period of time, I think the emphasis, if you have to be a portfolio manager and an equity analyst, is to move away from watching market internals and fund flows to figure out which company will attract fund flows over a longer term period. So really that's the essence of what we have to focus on. So I agree that we're probably not at the best in terms of macro environments and news flows. But if I just step back to 2007, where we had everything going for the economy, for the global economy, etc., it was not really the best period to put money into the equity asset class. and you have something exactly the reverse happening at this point in time. So we're not saying that it's all over and done and you will walk away with significant amount of returns on the tables. There is a risk reward element to it all. As we look into the balance remainder of 2013 and some part of 2014, you can only see headwinds coming your way. And those headwinds result in the other extreme, which is valuations on the ground, and some of the companies and some of the entrepreneurs out there who have learned to live with this challenge and built it through. So that's what we want to focus on.
But Kenneth, the index, and when I say index, the Sensex and the Nifty, based on FY14 estimates, they are trading at a P of about 12-13 times. 12-13 times is not exactly attractive.
I mean, we switch back again to the same argument. At a headline number, indices really do not make money over a longer term period. If you look at individual companies right through the last 4 or 5 year cycle, I think you've been able to spot companies who have built a franchise in the environment. You've been able to spot companies who've really grown market shares, and that's what you need to focus on. So I'd agree with you. Headline numbers or indices may not be conducive or may not be nice to look at. But if I just stretch that argument a little more, I mean, that's what you need once your portfolio is built. I mean, you need the headline index to actually do once your portfolio is completely up and running. And we're very happy if we are in this zone for the next 12 months or the next 18 months. As long as the individual companies out there demonstrate growth which is beyond market expectations.
Kenneth, mid-caps have been a speciality with you. In fact, names like, a Kaveri Seeds or a Page Industries that you did invest in via the IDFC Premier Equity Funds have done very well in the last 1 year performance. Is it time now to take chips off the table in stocks which have had a good performance and have outperformed the index perhaps?
I mean, that's an ongoing process. So we have taken money off significant amount of companies in each of these portfolios over a period of time. And that's essentially where the focus remains. Is if you have to build an environment, or if you have to build an investment process to make it consistent with what IDFC as an asset management business has done over the last 7 years in the equity business, we need a couple of more products. We need to see a lot more entrepreneurs featuring in our list of investable companies. So this environment will throw up a lot of these names even in future. So focus is to get there. What we do with our existing business is try and, over the existing companies and existing companies that we've aligned ourselves with, is to look at how quickly the business is actually maturing and whether there is still growth left, or if the company still has a very strong product pipeline to retain its dominance in the business. Then these companies can last for an extremely long periods of time in the portfolio. So we do take money off the table while we also introduce a lot of new companies in the entire portfolio. I think if we as a business, we try working with a 60-65% probability rate, which is a very high success ratio in stock picking. But if we can maintain that consistency, I think portfolios should not disappoint.
Kenneth, every time we've interacted with you, you've always given me new ideas. 2 years ago, you told me airlines, then it was consumer names, then NBFCs, then liquor companies. What's your big idea now for FY14? Where are you putting your money to work?
Okay, just to put the context into place, I don't think there's a spot of opportunity that we're really looking at. I think India will still be a very large consumer market. But in the near term, I think it's a reasonably large macro call on when the environment itself will be conducive for growth, okay, for a step up of growth. And I think we have reasonable amount of headwinds coming our way for the next 12 months. So if I put my, if I have to articulate ourselves as far as why these opportunities came out there, I think one single reason that all these companies played through, or all these segments played through, because they were all consolidating businesses. Okay, every single one of them that you mentioned, they were all consolidating businesses. So as we go forward into the next 3 years, we'd like to spot more opportunities which are essentially consolidating, which is why it's such a big macro play now, because at a 5% growth rate, you've got a lot of capacity on the ground. The bottom end of the industry, or the bottom end of corporate India, is actually getting wiped out. So they won't be around for the next couple of years or into the next cycle, simply because their balance sheets are too stressed out. So the focus remains is pick that vertical, pick that niche where the leader is actually gaining market share. And if he is profitable, if his cash flow dominates his entire business, and he's very low leverage on the book, I think that answers 90%. Your probability of success can move as high as 80%.
Right.